everyone, it is Saturday the 27th of June 2020. I'm having a look at the global indices and starting off with Wall Street on the day. So we have a lower high and we've got a recent low here. So we look very much as though we're going to break this low and then go into a downtrend on the daily. The weekly looks like a really strong bearish rejection of this 26,000 levels, and the monthly is forming a bearish candle. So we've got a few days to go actually, and then we're there. So of course what I'm going to be doing in the early days of this week is looking to see if this plays out and we break that trend. We've closed as a bearish rejection candle and we form a weekly bearish candle. We break the low of that. All of that then means price will head down towards 24,000, 22,000, and we might actually have a very aggressive week to the downside. So this is very much in line with the reality of the situation. If that is the case, if how it unfolds, we've got the potential for obviously because the US economy is the largest in the world, it largely drives what's going on at the moment. It is almost 100% responsible for the upheaval that we have experienced since February. Simply because if the US economy has a really bad time, if the US markets have a bad day, everybody gets it, okay? It impacts the entire planet, impacts all the other indices. So, taking into account that the US coronavirus infection rate has now spiked very aggressively, it's gone almost parabolic, and it's taken over the previous high that they had. But the death rate is actually not as high. The death rate is turning and starting to increase, but the numbers are still relatively low, and the tensions that are going on in the US are still increasing and ongoing. What we really have now is very similar situation to what we had in February and March, except that it's worse because coronavirus isn't just kicking off, it's already established, and therefore if it takes off from here, it's taking off from a base of an existing infected base. And the tensions are rising, and there's other stuff in play that wasn't in play then, and so there's a whole lot of reasons why fundamentally this could be another big move to the downside. Again, I'll trade it when I see it and not beforehand, all right? Because everyone was expecting it all the way along here. And yes, it is a reasonable expectation, but the market will do it in its own time and not for our convenience. So I'm just looking at the signs here. I'm also looking at the location of this. All of this indicates that if in our future, for the rest of 2020 or 2021, we are likely to have more of a bear market, almost entirely as a result of Donald Trump's decisions as a president, because there's nowhere else we can lay that kind of at. We're likely to see this move continue to the downside. So it's setting up for that as a potential, and the signs are there in the early stages of it, but I will take it a day at a time, I guess is the best way to put it. Now, it is also at the same time a reality, because we've seen climbs in the past that we could turn around here. The bulls did make a comeback last week, as we discussed. That is a possibility, and they will still be here in all these areas. The fact that the market was climbing while most of the economies are not really doing that well is not a testament to the markets are not a true reflection of the economies. Not at this point in time, at least not at this point in history. And they are more a reflection of spare cash and capital, as well as, any other programs such as QE or any other kind of injection of cash into the markets. We're seeing a lot of that being applied here. But at the same time, we're also seeing companies, even just yesterday, I think Chuck E. Cheese now filing for bankruptcy. So we are still very much at risk. And in fact, if you think that this is played out, it is nowhere near played out. We could be at the start of something that goes on for the next couple of years, where we just see more and more of this. We kind of see growth, and then we see a collapse, and then we see more big companies and high street shops kind of closing down. So this is important to kind of discuss it now, so that we have some kind of a roadmap to play out as traders. Right, so one of the beauties of being a trader, of course, is that we can trade the market to the downside. And we are potentially likely to have multiple moves like this. And so we won't really be able to recover. If you think about it, we cannot really start to recover until we get coronavirus under control, which means that, similar to New Zealand, we need to find a way to effectively eradicate it. And we have to do that by kind of just knuckling down and just waiting it out, and employing social distancing until we get some form of immunity to it that we can build up. In the meantime, we're just going to have to do that. We don't really have a world war that we have to struggle with. This is our generation. This is our generation's big challenge. Okay, so that's the way we should probably view it. At the same time, at that point, we can then start to get businesses will adapt, economies will adapt as well. Then we'll start to see different ways in which we can start to recover from it. And of course, we're going to take a hit. So it's reasonable to anticipate that the next 6 months to the next year is going to be tough for a lot of people. And I think some empathy for people in this time is probably due. Looking at the S&P 500, we have the same situation. We never broke above or below the highs, so we still don't have a clear trend. I mean, you could argue there's a downtrend here, but we are showing bearish, strong bearish signals, at least at the start of this week. If the market just disregards it, that will be an indication, obviously, that there are an equal number of players of both bears and bulls in the market. And so 1 week the bears will win a bit, and then the bulls will win, and so they're well matched. Looking at technology, this is a big one. So the NASDAQ is really the strongest one. And what you can see here is, so far, at least last week's rejection candle, combined with the highs of the 2 previous weeks, is finding 10,000 incredibly difficult to break through. And that doesn't bode well. We've had a really big move up. We could find that if we break down, we'll potentially have a move down towards 9,000 at that point in time, which puts us down towards these levels here. And it always moves down fast. It'll be more aggressive. Is there divergence between these highs? Let's go ahead and have a look at that. Let's reduce that. There's a very clear bearish divergence on both MACD and RSI. So they are pointing at a strong technical likelihood. Combined with the bearish weekly candle, the monthly looks okay. Or other than the fact that last week and this week I stand by it, we are distance-wise away from the moving averages. We are now in an area where a pullback in terms of distance away from the moving averages is acceptable and reasonable. The bearish weekly candle implies that the divergence plus the bearish, just this big bearish candle here implies that we could see a much bigger move down. And this time round, it's also fair that it's reasonable to think that if we do get a big aggressive move to the downside, it's going to be more aggressive than the previous one. Because in other words, it would be a first time panic, then a recovery, then a second time, okay, we can't go any higher, then it's a bigger panic second time around. So that's just something I just kind of want to consider that as a possibility. Looking at the fangs in isolation, they're definitely overextended from the moving averages. We're in a higher risk area. We also have a bearish candle here. We also have bearish divergence, and we also have a bearish candle here. This is indicating that there is a strong likelihood that this week we could see a big move to the downside. And of course, as I said, I'm always prepared for the bulls to come back in and prop it back up. But this time round, we have more bearish signals, combined with, as we know, massive spikes in certain US states as well. And I'm focusing on the US in this discussion because of the impact. If they knuckle down and they can fix everything, then the rest of the world can start to recover from there. And certain countries that can look after themselves in this time will be okay. So there we go. Russell 2000 has a similar approach. FTSE, let's look at the FTSE. Again, no clear change. There's a key level at 6,000. If we break back below that and we break the previous low, I expect that it's reasonable for us to see a bigger move to the downside. Looking at the monthly, that would then become, as I said, a nice rejection of that level from a trader's perspective. Because these aren't truly necessarily a reflection of the economy, I don't think we should necessarily take all of this as in a dire reflection of what our future holds. This is merely a reflection of the true economy combined with the secondary economy, or at least the one of kind of where there's quite a bit of money going into corporate. I guess you could say it's corporate. All right, so having a look at this as well, Hong Kong, I apologize, it's a very long video this time, and I don't mean to be political. I'm not always political. I'm aware of how this particular situation has become politicized. It isn't at all anything to do with politics. This is a disease that's impacting us and our economy, but somehow we've made it that way, and this is just bizarre to me. So again, we've got the Nikkei not really going anywhere. It's consolidating. It's basically looking potentially as though it's going to break out. It's got some strong resistance. Could be a lower high here as well, and strong resistance up here. So in isolation, again, I'm cautious. I'm wary of this. This as well, potentially a level of support that we break down on the ASICs, and then we start to head lower on that. So just to recap, going back to this is my thing. I'll be watching Thursday, I'll be watching the tech markets, S&P and Wall Street, and even the US, even the Asian sessions, the Tokyo sessions as they open up tonight. On Sunday night, I beg your pardon. I'll be looking to see if we have big moves down on the Monday and Tuesday, and if they're really big and aggressive, I'll be prepared for that. Then my entry opportunities are on the 30 minutes and 1 hour to the downside. Again, I'm maintaining these levels. These are going to stay highs and lows, and then pick up on that. So I'm just saying, in terms of the weekly and daily and monthly combined with divergence, there are technically signs that this week could be a really big down one. At the same time, I've seen the bulls step in at those lows, so I'm prepared for both. But I have to say, we could look back at this in a couple of weeks' time and see that was the top where we had a big move to downside. If nothing else, I'm just increasing caution, and we'll be watching as well from the sidelines. And that's it. Stay safe, everyone, and have a great week otherwise.